Hello, I'm Tony Kaye. I'm the editor of Eureka Report, and I'm talking about the latest superannuation changes with Bruce Brammall, our superannuation editor. Welcome, Bruce.
Thanks, Tony.
Bruce, I just wanted to have a more detailed discussion about the 1.6 million transfer benefit cap. How would that actually work?
Well, for anybody now who has more than $1.6 million in pension or in super to a degree, you're going to be able to have from July 1 next year a maximum of $1.6 million in a pension fund. Pension funds, as we know, are tax-free, completely tax-free. They don't pay tax on income or capital gains. And what the government is trying to do is to put a limit on how much money you can have in a pension fund. If you have more than that currently, or are likely to have more than that when you go to turn your pension on in a few years, you're going to be limited to having that 1.6 million. So those with bigger pension funds now are going to have to look to transfer back a portion of their superannuation back into accumulation or superannuation phase, so that if you had, for example, $2.5 million in pension at the moment, come July 1, 2017, $900,000 of that will have to roll back into accumulation, where it will be taxed at either 15% for income and 10% effectively for capital gains.
I suppose in a lot of cases it'll be fairly straightforward, but there may be situations where it's a little bit more complicated, particularly if you're holding hard assets like, say a property. What would happen there?
Well, what we believed was going to be the case, and it's turned out not to be the case with the legislation being passed, is that you would have to segregate your assets and decide which assets were in the pension and which assets weren't going to be in the pension, were going to be back in accumulation. The government and through the legislation said we're having none of that. If we're going to, it's going to be proportional between the assets in the fund that are in pension and the assets that are in accumulation. Obviously, if it's a multi-member fund, you may have two people in pension and the same two people having an accumulation fund. You might have one pension, two accumulation, any number of those. But what it's going to be proportional tax rate, so that if you do go to sell something within the fund, you'll have if half the fund is in pension and half of it's in accumulation, then the tax will be essentially taxed on half of the gain at superannuation tax rates. So how's it going to work in practice? Well, deciding which assets are in and out of the pension fund is not going to be important. As I've written recently, however, though, the one way of doing segregation, if you did really want to segregate your assets, would be potentially to open a second self-managed super fund, because it doesn't look like at the moment that the ATO or government, the ATO being who runs tax office, who administers tax funds, self-managed super funds, will be able to do a non-segregation policy over a number of super funds, but it's still something that's being looked at.
And are there any implications for people who have perhaps borrowed to buy property in their fund? Will it work the same way?
Well, it'll be presumably done on net assets. So if you have a $500,000 property with $300,000 worth of borrowings, the net value of that asset is $200,000. So borrowings are going to become a little bit complicated in superannuation and pension, and as to where how the taxation is going to work, but in essence, there's nothing to stop you continuing to do limited recourse borrowing arrangements. But when it comes to paying a pension from a super fund, you're always going to need to have the liquidity to be able to pay the pension, and having to service borrowings makes often meeting that liquidity to pay the pension a little bit more difficult.
Some people have asked if they get up to that $1.6 million cap and they draw down pension out of their fund, are they allowed to top it up? My understanding is no.
No, you'll be set a limit when you turn on your pension, and if you use your 1.6 million, that's it. You won't be able to ever get any money back into pension fund, any extra money back into the pension fund again. If the $1.6 million grows reasonably well and has a 5, 6%, 7% growth about it for the year, and it grows to 1.7 million, you draw your 4% pension of $64,000 at the start of the year if you're in that age bracket. Then your pension fund has moved forward, 100,000 earnings less 64,000 in pension being paid out, and that means you've got 1.63 million in the super fund. You don't have to reduce that, but you can't top it back up. So if you have negative earnings for a year and it goes from 1.6 to 1.5 and you're drawing a pension on top of that, and you're down to 1.45 or thereabouts, then you're not going to be able to top it up. The only way that you will be able to top it up is when you turn on your pension initially, you haven't used the full cap. Let's say you turn on a pension, you have $800,000. When you turn on your pension, then you are able to top that up over time to the 1.6 to up to a maximum of 1.6 million.
And the government has said that they'll be increasing that 1.6 progressively in line with inflation.
Essentially, yeah, in line with inflation thereabouts. So the 1.6 will move to 1.7 over a period of time, a number of years, 5, 6, 7, 8, 9 years probably, and they'll be doing it in $100,000 increments.
And as you've said, any excess funds would be in a accumulation super fund, essentially.
Yeah. So back if you are tipping money back or having to leave money in over and above your cap back in accumulation, you'll be paying tax at a maximum of 15% for income and effective 10% tax rate for capital gains. But people are going to need to look at whether, in some cases, you have your 1.6 million in pension, which is completely tax-free, and then whether you have an amount of money outside of super earning amounts, depending on your asset mix outside of super. But obviously, the first, $18,200 for anybody outside of super is tax-free. But given some of the benefits that for older Australians, the SATO, etc., you can actually earn well into the $20,000 mark before you actually start paying any tax. So 1.6 million in your pension fund, an amount outside of super potentially, maybe $500,000 or $1 million, depending on what it's earning, on which you'll probably pay no tax. And then, possibly a third bucket, which is what's sitting left back in the accumulation phase of super, where the most that you're paying in regards to tax is 15%.
All right, Bruce, we'll leave it there. Thanks very much.
My pleasure. Thanks, Tony.
Thanks. I'm Tony Kaye, the editor of Eureka Report.